back. You're watching the 80 Money Show with me, Kavita Thapliyal. Now, capital market regulator SEBI recently placed caps on the share of assets an actively managed fund can park in a single company's debt instrument. On the 80 Money Show today, we will dissect what this latest directive from SEBI means for investors and fund houses and its implication. Let's bring on board Suresh Sadagopan, founder, Ladder 7 Financial Advisories, and Lakshmi, Iyer, CEO, Investment Advisory, Kotak Investment Advisory Ltd. Welcome to the show. Lakshmi, first question to you. Now, SEBI has placed caps on the share of assets an actively managed fund can park in a single company's debt instrument. The limit, however, varies based on each issuer's credit rating. Now, that for a retail investor might sound great or very complicated. In layman terms, Lakshmi, explain us, what does this mean?
Yeah, hi Kavita, good evening. In pure and simple terms, if I were to give you an example, if you had 100 rupee of portfolio to invest in a bond fund or in an open-ended debt fund, it meant that 100 divided by 10 rupees per issuer is what you could invest, and that was irrespective of the credit rating of that particular issuer. Now, what SEBI is saying is that if it's rated AAA, then you can continue with that 10%. But if it is AA and AA has the AA plus, etc., or if it is A and below, then it has to be at 6%, which means that if you are creating a same portfolio of 100 rupees and it has AAA, AA, A plus, A minus assets, it cannot be just 10 bonds or 10 issuers. It has to be more than 10. So you have to diversify more into your portfolio basis the rating of that individual issuer is what SEBI has communicated.
Few lines from the notification I'll read out, and I want you to explain all this to us. Now, a very important thing in the notification is also, it also says that in order to avoid inconsistency in investment by mutual funds and debt instruments of an issuer, irrespective of the scheme being actively or passively managed, it has been decided to introduce a similar credit rating based single issuer limit for actively managed mutual fund schemes. Now, what kind of inconsistency talking about, irregularities are talking about, and what does it mean for an investor?
No, what they're trying to say is that in May 22, they had, a similar kind of guidelines for passive funds, which means that funds which largely mirror the benchmark, like we have equity index funds. Similar to that, we have passive funds on the fixed income side. So they introduced that in May 22. They have just extended that and and that's what they're referring to, the inconsistent part. They've extended that to the actively managed funds. That's what they're trying to say.
Talking about this kind of capping in an active debt fund, what could be the reason to introduce this?
See, if you look at the corporate bond market, and I'm talking about the secondary market where you can buy and sell quite regularly in the wholesale market, the typical, observation has been that the AAA bonds, which is public sector or private sector, are the most liquid. And that is followed by, as you go down the rating curve, the liquidity tends to recede quite significantly. So primary market, when you are buying the bond for the first time from the issuer, when the issuer is issuing, that is when you see the action happening, and then after that to sell or buy in the secondary market seems to be a task, and that's what has been the observation. So looks like the intent, and it's quite well intended, that you want to reduce the overall illiquidity risk in the portfolio and also use this benefit or use this opportunity of diversification overall. But I must hasten to add that if you generally scan through fund portfolios, there is seldom, unless there are some exits from or redemptions from mutual funds or schemes because of which these proportions go up. In general, you don't find individual schemes actually using up to 10% limit for the lower the rating buckets. But yes, it's well intended to ensure that there is reasonable liquidity if the world were to come to an end.
Suresh, now in what scenario investment limits may be extended?
So I would say that this is a very positive move. Like just now Lakshmi explained, They have made it uniform between passive and active. In my opinion, the other point is the concentration risk. One is the liquidity, and one is the concentration risk, which can be there in the portfolio to some extent if I mean the previous dispensation were there. And now with a lower allocation, lower cap of 8% or 6% for the for those AA and single A papers, I think the concentration risk of the lower quality papers is I mean lowered. Number one. Number two, see, this is intended at typical retail investors. See, mutual fund as a scheme is intended at typical retail investors. They don't really understand these kind of things. So SEBI is coming up with a lot of these rules to protect the retail investors, I think, which is also very well intended. So like if it is if a fund is largely a AAA rated portfolio, I mean, that is what they will say. I mean, the various sites will also show it is AAA rated. But how much is AA and how much concentration is in AA? If you drill down deep, you will find that, but the retail investor may not necessarily know that. So this one actually, even if they don't look at that, it kind of puts a cap on how much can be a AA issuer limit or a single issuer limit within the fund, so which is a good thing from the retail investor point of view.
On the understanding of rating, Suresh, for us, what does AA mean and what does AAA mean?
Yeah, AAA is the highest rating. It signifies a very high chance of getting back the principal and the interest. AA and single A will go down that scale. There will be reasonably good chance of getting the interest and the principal and so on. So it'll go down, and below A will be the non-investable investment portion. So, I mean, a lot of retail investors do not understand these things very well. They look at AAA, AA, and A, and yeah, 1A missing may not really mean too much to the retail investor. So, I think from that point of view, SEBI understands this quite well, and what they have come out with is, I think, a good thing from the retail investors' point of view.
Lakshmi, in what scenario the limits can be extended?
So they say that if you want to, go beyond this threshold, then it has to be taken to your respective boards. And that's only in exceptional cases. So if there is a scenario where the supply of corporate bonds are, quite minuscule in number, which is not the case right now as we speak. But in scenarios like that, would any fund house want to go to their, respective boards and get clearance for allowance of another 2%? That's possible. That is there even today in the regulation. So they've just maintained that. So it's a 10+2, which can be allowed today, even with your board approval.
So what kind of flexibility or restriction or harder restriction a fund manager could face now, Lakshmi, because it's all about making your debt portfolio healthy. What do you think, and how do you think a fund manager will be able to act?
So, Kavita, in my mind, it's not a material showstopper. And, I mentioned this, Suresh also rightly pointed out, you're trying to move away from a concentrated portfolio to a more diversified holdings. Of course, one can debate that the underlying corporate bond market is not that very liquid, but it cuts both ways. It also augurs well that you have a reasonably well-rounded portfolio because this is actually, appealing to a 5,000 rupee investor as much as it applies, appeals to a 50 crore or 500 crore investor. So I think you need to keep that in mind, that this diversification is probably, a thing which is pretty much the order of the day. And I think from a portfolio construction perspective, instead of, I really don't see too many schemes in the fixed income space which really operate with 10 or 12 stocks or 10 or 12 issuers. So it's pretty okay if this restriction or this circular comes in place. We also need to keep in mind that the current exposures are grandfathered, which means they're allowed. So it's not going to be a disruptive move also by the regulator. It's for all the schemes which are launched with effect of the date of the circular. So I think it's pretty okay. I don't think it will be a showstopper from a fund management standpoint.
All right. Now, just to understand, Lakshmi, if the instrument or the investment instrument is actually of a longer term, you think the short-term credit rating would actually make sense? How would the rating change if it's a longer term instrument?
When you are evaluating a credit, Kavita, you have to look at it from a very near-term perspective, which is why the short-term ratings matter. And of course, when you are investing or lending, as the case may be, for a slightly longer horizon. And when I say longer horizon, about 1 year, because that's where the short-term ratings don't get applicable. That's when the long-term ratings are looked at. So the most appropriate way of evaluating any investment, therefore, would be to look at the long-term rating wherever it's available, which is available in bulk of the cases. And that's exactly what the circular has said, that when you are, putting these restrictions, or when you are creating your portfolio, please have a look at the long-term ratings as you are planning your investments. And again, as I said, you have reasonable amount of issuances available today, even in the shorter end of the spectrum, to be able to create your portfolio. And the non-triple A short-term high-rated issuances also are pretty reasonably good in number.
A quick checklist, although you answered a lot in this particular question itself, but a quick checklist for investors to select a debt fund. Lakshmi.
So first and foremost, look at if your portfolio is well diversified. That is rule of the thumb. You don't really have to worry about the liquidity, because most open-ended funds offer liquidity on a T+1. So you put a redemption today, you get the money tomorrow. That's true for most open-ended debt funds. Look at the consistency in terms of performance, though there are multiple ratios and risk metrics, but I think look at from a consistent standpoint in terms of track record, how the performance has been. Has the fund house or fund manager taken an excessive risk, either on the credit side or on the duration side, to be able to deliver those returns? And most importantly, during critical inflection points, which is a strong event, a global event, a macro update or a micro trigger domestically, how has the volatility, as in how fluctuating have been the returns? I think these are, of course, there are many more checklists, but I think these are some of the apparent check the boxes, I think, that the investor could do, either individually or along with their a distributor or advisor, to be able to arrive at the optimal solution.
All right, got it. Thank you so much for being with us and explaining this entire circular to our viewers, Lakshmi. Suresh will stay on with us because it's time for a quick break, and after that we'll be talking to our viewers and getting their portfolio sorted with Suresh Sadagopan after this break.